The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Welcome, everyone, to the Sirius Report Market Wrap-Up for Friday, September 13th, 2024. For those yesterday, when I put up my market wrap-up, unfortunately, the algorithm did not like the fact that I used information and pictures, images of other websites. So, once we got notification on that, I had to take it down. And thus today we're doing the market wrap-up. We're going to be doing it audio until we can figure out a way to be able to show better graphics in some capacity. So for those who enjoyed the previous, where I was able to move from different news source to news source, I apologize for that. But until we figure out a good way to do this with under any legal ramifications, this is going to be the market wrap-up. So with that in mind, let's go ahead and jump right in and see how the markets fared. Taking a look at the Dow. After another big day yesterday, we had a 297-point move upward, with the expectation, of course, with next week being the Fed week. Dow was up 297 points, closing out the week at 41,393. Meanwhile, the S&P 500 continues its move upward, up 30 points to 5626, and the Nasdaq was up another 114 points to 17,683. Well, bond yields all fell today across the board, from the 2-month all the way to the 30-year. This is a reversal of what has happened the last 3 days in the market, primarily with auctions in the 20-year, 10-year, and 7-year. And surprisingly, all were decent auctions that should have caused the yields to regress, but instead they all spiked forward at the same time this was happening. The 2-year and 10-year, or 2-year and 10-year continue to no longer be inverted, with the 10-year about 10 basis points ahead at 3.657. Meanwhile, well, we were able to save at the end of the trading day, probably the last 3 hours of trading, we were able to save the 101 handle on the dollar in the dollar index. At one point it was down to 100.86, but then a reversal brought it up to the close for the week at 101.11 on the DXY in regards to the dollar versus a basket of currencies. However, the gold markets did see a continuing move upward, especially heading into next week. Silver was up 85 cents to close out the week at $30.80, with a high of $30.98. It started retracting after it nearly got to 31. Gold, meanwhile, set a new all-time high at the close, up $19.40 to $25.78. with a high of $25.85. Now, one of the interesting things that I mentioned in yesterday's market wrap-up was the fact that UBS and ING, two banking financial institutions, have publicly come out telling investors to buy physical gold. Now, usually when they talk about buying gold, of course, it's in the ETFs, something they can control, but it appears that they can no longer mask the fact that the dollar is under serious pressure and that gold is a great safe haven, especially with stocks at all-time highs, the bond market not a very safe place to store money. And of course, it's being purchased by central banks and institutions all across the world outside of the Western financial system. Moving over to cryptocurrencies. Well, we had a little bit of a move upward in both Bitcoin and Ethereum today. Bitcoin closes out the last 24 hours, reaching back to the 60,000 handle. It was up 3.61%. At closing right now at 60,287, while Ethereum was up 3.23%, closing at this point 2438. In the oil markets, well, we had a little bit of a rope-a-dope for both WTI and Brent today. WTI started out up about $1.40 and was over $70 a barrel, but after getting beaten down into the red after being up in that high and then going back to the green, it actually ended the week down 32 cents at 68.65. Meanwhile, Brent crude ended the week up 13 cents to 72.10. Some of the news that's of importance as we get ready for Fed cut week and the FOMC next week. Inflation expectations in the University of Michigan sentiment show that it is surging. After a hope-filled rebound in August, analysts expected the University of Michigan sentiment in preliminary August data to show further improvements with inflation expectations flat. They were right in their prediction as the headline sentiment beat expectations, a 69 versus 68.5, as did the current conditions and expectations sub-indices. The gain was led by an improvement in buying conditions for durable goods, driven by more favorable prices perceived by consumers. Now, this is, of course, one of those interesting data models that is considered soft data rather than hard data like CPI, PPI, and unemployment or jobs. But nonetheless, this is usually the University of Michigan sentiment is what businesses think of the consumer, not what consumers think of the economy. Well, endgame. Interest on the U.S. debt surpasses $1 trillion for the first time ever, exploding as the August budget deficit was $380 billion. 2024 was the year when the runaway U.S. budget deficit was supposed to gradually normalize, and after 2 crisis years, the U.S. was supposed to end its drunken sailor spending ways. For a while there, it seemed touch and go, with the cumulative U.S. deficit initially overtaking 2023, but forget about that when the deficit hit a mind-boggling 18% of GDP. This was before slowly easing back last few months, only to sprint ahead back last year in August. And then, of course, a year later now, we have that $383 billion. This is up more than 50% from the $243 billion in July. And the more interesting thing about this is that we are not shipping as much money or arms to Ukraine as we did a year ago. So we've increased it, not just because of paying more on interest payments, but because the Congress and the fiscal spending, they cannot keep track of their own pocketbooks. Now, why is this interestingly important? Because it's going to bring talk now of what the Fed is going to do and whether the rate cuts are going to actually have any benefit or able to do anything with the general economy. Likely a half point cut or even a 50 basis point cut is not really going to do much because, and we're going to get into a segment here shortly where we're going to take a look at a quick history of the Fed and Congress, because there are two sides to this coin. There's the monetary policy and there's the fiscal policy. But with that being said, market speculation about a 50 basis point rate cut by the Fed next week returned after last night, after the Financial Times and the Wall Street Journal called the Fed rate choice between 25 and 50 basis points a close call. Former FOMC member Bill Dudley said there was a strong case for 50. Now, the rate slashers are back from hibernation. Inflation has kept them away for a few years, and we already know from earlier this week, CPI and PPI are reversing back, so inflation is coming in, but it's also fighting a declining general economy, so we have massive stagflation. Now the central banks have their inflation targets in sight, and they are back to cutting. Yesterday, they struck in Europe, which lowered by a 1/4 point, and next week, they will do the cutting cycle in the U.S. Now, here's where I'm posing the question, is it really going to matter? Conventional wisdom has it that the Federal Reserve System, or the Fed, and the U.S. Treasury Department are two separate entities. Congress created the Fed in 1913 as a legally and financially independent federal agency, privately owned by its member banks with no funding from the federal budget. We already know that's a hogwash and a load of garbage. But here's the important thing. Regulations, spending, revenues, etc. are all the purview of Congress. That's the fiscal policies. In 1913, when the Fed was created, the original mandate is that the Congress could not use the Fed to monetize treasuries to get money, to borrow money. It was simply a means to stabilize the banks from any runs and to go ahead and protect the dollar and price through inflation, control prices. The mandate of low unemployment did not come into being until the 1970s. So that was a fiscal policy that Congress was in charge of until they could no longer deal with it because of their outrageous spending in the late 60s with the welfare state and the Vietnam War. And so they pawned it off on the Fed, just like they pawned off everything since 2008. But due to World War I, just 3 years after the Fed was created, the government needed money, and so they changed the legislation so that the Fed would monetize war bonds. Okay, that is probably necessary during wartime. But when the war ended in 1918 and the U.S. Congress all of a sudden said, oh, we love this extra money, we're not going to retract the Fed monetizing U.S. treasuries and giving us as much money as we can borrow. So that was in part what led to the Roaring 20s and, of course, the stock market crash leading to the Great Depression. But here's the problem. With the Congress being able to borrow money at will and the Fed now being forced to monetize it at will, anything the Fed does, if the Congress does not stop spending and the Congress does not rein in its own budget, it doesn't matter what the Fed does. It's going to harm many different parts of the general economy. So that's the question, Powell, or the corner that Powell has been forced into. Now, I'm not here to give Powell a pat on the back. Pretty much every Fed chairman, even going back to Greenspan, has done some really bad things to destroy the dollar and destroy the U.S. economy. But Powell has been stuck with having to deal with the Yellen and Bernanke years, this massive deficit, this massive balance sheet that the Fed has, and a Congress that tried to push through modern monetary theory or just money printing. And so what else can they do? They had to deal with inflation, but they're also dealing with the fact that the Congress won't stop spending money. They won't stop borrowing. And thus we have this massive 35 and some odd trillion dollar national debt. And we have, of course, now a GDP to national debt of about 130 to 140%, which for every dollar the Fed creates out of thin air, it does less and less and less, likewise probably about 40 to 70% towards GDP. So you've got to spend $2, $3, $4, $5 of newly printed money just to get $1.5 of GDP. So that's the question that's going to come forward. And when the Fed does do its cuts, what Powell is really doing is saying, I'm giving up on the dollar, because the more that they cut, the more that they devalue the dollar, the less the rest of the world is going to want to own those dollars, and they're going to de-dollarize even faster. Well, one other thing that's suddenly coming across, earlier this year, we had to deal with freight strikes as well as freight companies going bankrupt. Now we have some of the ports that are going into strike, especially at a time when the U.S. Government is trying to curb imports from China. East Coast and Gulf Coast ports handle about 43% of all U.S. imports, And a new strike is beginning on October 1st at 13 of these ports. Contract between ILA and the U.S. Maritime Alliance, which negotiates on behalf of management of the ports, terminals, shipping lines, is due to expire on September 30th. Contract covers 25,000 workers for ports stretching Boston to Houston, according to the ILA. Billions of dollars worth of imported goods, from cars and light trucks to electronics, food, all come through these ports. So this is going to be something that's going to be occurring 1 month before the election if it doesn't get settled, and if they end up ceding to the workers' demands, that's going to increase inflation, because the price of the cost of goods coming in from exports are going to rise, and we're going to end up paying for it. Well, looks like meet the new boss, same as the old boss, with Trump pointing his fingers directly at China in the final year of his presidency back in 2019. He put a 25% tariff on all Chinese goods, or most Chinese goods that came in. And the Biden administration decided that they were going to go ahead and remove that and try to appease China. But now, with just 2 months left before the election, we have the Biden and Harris hit team. Don't know if it's actually Biden. Who knows who's running the policies of the White House? But they're going to put new tariffs, and they're dedicating themselves at Temu, of all places. Now, what is Temu? Temu is like Amazon, only it's a Chinese site that sells goods from all over the world, mostly Chinese goods, and they are pretty much undercut prices of what you can find in Amazon and other U.S. online portals. So, besides going after the chips, Chinese chips, besides going after the banking system with SWIFT, and now going after Temu, pretty much the U.S. is telling the world we can't compete with China, and we've got to cut them off and force them to have higher prices. Think about this. We can't have Chinese EVs. And Chinese EVs are much cheaper than the Teslas and anything that's coming out of U.S. auto manufacturing, and they're much, much better, at least from what's being shown at some of the car shows throughout Southeast Asia and even in Europe. But also, you have to take into consideration that China has now been forced to create, instead of relying upon Foxconn, creating Apple and doing a lot of the technology, now they're doing their own. And because they're doing it better and they're doing it faster, the U.S. can't keep up with innovation. And the interesting thing is besides going after Temu and in import exports, there's another important race. It's not the AI race, but it's the race for the ultimate energy source. American policymakers have spent years decrying the loss or impending loss of key competitive sectors to China, including 5G telecoms, solar panels, advanced manufacturing, and quantum computing. Recently, it was reported that China was outspending the U.S. on fusion energy, and that it could surpass U.S. fusion capabilities in 3 to 4 years. What do you bet that they will do so in less than a year? Fusion will provide reliable carbon-free electricity for an expanding global economy, and it's pretty much, once they get the technology set, this is the golden goose. It will have profound geopolitical consequences, and according to the U.S., if we allow China to dominate fusion technology and to deploy it at scale at home and abroad, Beijing will hold the central position in the geopolitics of energy going forward. So, this is the key. The fact of the matter is that everything that the U.S. has done in putting up tariffs, in cutting nations off from SWIFT, and forcing China, the BRICS, the Southeast Asia to go their own way and avoid using technology or innovation from the West, they have only accelerated their capacity to manufacture it, and it looks like very quickly they could become naturally, thanks to the US and Europe's own short-sightedness, masters of energy. And if you have masters of energy, you pretty much control the world at large. Anyway, I want to thank everybody as always for stopping by to get your market wrap up from the Sirius Report here on Friday, September 13th, 2024. As I mentioned, this is a work in progress, so hopefully you all are enjoying the information. And as soon as I can be able to get the capacity up, we will put some graphics and something that will allow you to follow along with the information that I bring. With that in mind, until the next time we get together, everyone, have a great weekend.